Hi everyone, thank you for attending this webinar today about support and resistance trading in FX. Before we continue any further, I would like to confirm if all of you hear me fine and you see the presentation and the presentation only. Awesome, thank you very much for the confirmation. We'll kick off the webinar within the next few minutes. Before we go on, I would like to go through the risk disclaimer quickly, and then we can start. Contents of this material are provided by third party, not hot Forex, and are for informational purposes only and do not constitute investment advice. Hot Forex and Blue Sky Binary assume no responsibility for any potential errors, inaccuracies, or omissions in this material. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of purchase or sale of any financial instrument. Any views or opinions presented within this material are solely those of the author and do not necessarily represent those of Hot Forex unless otherwise specifically stated. Currency trading may not be suitable for all investors as it carries a high degree of risk to your capital. Trading such products is risky and you may lose all of your investment. Past performance is not indicative of future results. Poor fill rates, expiry times, market volatility, and platform errors could result in losing trades. Before deciding to invest in currencies, you should carefully consider your investment objectives, level of experience, and risk appetite. You should be aware of all the risks associated with foreign exchange and currency trading and seek advice from an independent financial advisor if necessary. So with this out of the way, once again, welcome to the support and resistance trading webinar. Today's agenda is I'll quickly introduce myself. We'll then go through two market types that you will encounter during your daily trading. We'll talk about various types of SR levels, how to apply them to your trading, how to manage the risks when using the SR levels in your trading, and of course, as per standard, we'll end the webinar with some currency trading dangers and the Q&A at the very end. Now, today's webinar, it is more directed to the traders who are not really familiar with support and resistance levels. And I will also show on MetaTrader 4 on the live chart how to draw some manual support resistance levels, and also what exactly showing on the chart how they look like. Okay, so I am one of the senior traders in Blue Sky Forex, which is a part of Blue Sky Binary. We are an education, research, and a trading group, and we do provide 24-hour trade support analysis to allow binary option FX traders to trade safer. And Blue Sky Forex is presenting this webinar on behalf of Hot Forex in order to educate you and help you become highly profitable currency traders. Right, so now two types of markets that you will encounter during your daily trading is first price action, aka trending market, and then a mean reversion, aka a ranging market. A price action is definitely more powerful because by standard it is fueled by some significant news that has happened and actually driving the price significantly towards a certain direction. A mean reversion or ranging market is definitely more common. It is definitely easier to identify and definitely can be profitable. In terms of a trending market, it can be a bit more difficult to identify because you need to be able to adequately analyze the economic news ongoing and also what is happening technically on the market at that very moment. Depending on what types of support resistance levels you are using, that determines whether you should apply them in a mean reversion market or a trending market. Now, just a visual representation of a ranging and trending market. Not the best one though, but still gives you the very basic idea. On the left side here, you will see the ranging market. The price is essentially bouncing between the nearest support level, which is the lower black line here, and the resistance level, which is the upper black line here. Essentially, the price is ranging between these nearest support and resistance lines. As the upper, on this example, as the upper resistance line is broken, the price starts trending in a certain direction. Now, as you know that the price never moves in a linear line, never moves in a straight line, it moves in waves. Then you can see, as on this example, the price is going up. It's coming down a bit, retracing the move, and then again having another impulse wave upwards. After which the price consolidates, starts ranging again, when it breaks out from the range and starts trending. So essentially, this is how the prices move. Okay, to put it really bluntly. Now, price in the ranging market, as you could have seen in the previous picture, the price is essentially trending. Ranging between the nearest support and resistance levels, and this is just a bit of a better example of a really ranging market, right? Okay, what the price does in a trending market, and if we're talking about the horizontal support resistance levels, as soon as the price breaks out like on this example, breaks out from the top resistance, then the resistance level that it just broke becomes the price's support level. Okay, so as the price moves above the resistance immediately becomes the supporting level for the price. Okay, it's just really easy to understand and really important to remember. All right, and vice versa, if the price broke down the nearest support level, then this support level here becomes the new resistance level for the price when the price is below this level. So two very important things to remember. Don't worry, I'll show this on a live market a bit later as well. But first, we'll talk about quickly and review quickly the various types of support resistance levels. Now, there are psychological support resistance levels and there are technical support resistance levels. This is one way how you can categorize the support resistance levels. Psychological levels are the manual support resistance lines that you can visually draw on the charts based on what you see, what the price has done historically. And basically, one of the strongest psychological support resistance levels are round numbers. In example, 1.10000 is a really round number, and that represents as a strong either support or a resistance level, depending on from what direction the price is hitting that level. Okay, makes sense? Don't worry, I'll all show this on the live chart later on. And then there are technical support resistance levels. Floor, Camarilla pivots, Woody pivots, DeMark and Fibonacci. The floor, Camarilla and Woody pivot points definitely are one of the most used, most likely. They are calculated a bit differently, but they are all based on the pivot levels. Now this is another way how you can categorize support resistance levels. There are then three categories. There are horizontal support resistance levels. Then we're talking about the round numbers. We're talking about the manual horizontal support resistance levels you will draw on the chart visually. We're talking about the Woody Camarilla floor pivot points and Fibonacci retracement levels as well. They are horizontal support resistance levels. Then there are diagonal support resistance levels. We are then talking about the trend lines, an example. We're talking about the pitchforks, okay? And the third category is dynamic support resistance levels. And in this case, we are talking about moving averages, an example. We're talking about the Bollinger Bonds, Bollinger-based indicators. So this is another way how you can categorize the support and resistance levels. We are going to focus on the easiest and the main support resistance levels today, which are most likely the easiest to apply and draw on the charts and use to your benefit. Okay, so just on this picture, what you see here is it is a manual, it is a psychological support resistance level. In this case, it's a trend line drawn on underneath the price. It should be drawn on the top side of the price when the price is trending down. Okay, but this is a diagonal support resistance level. It's a trend line. The trend line should be actually drawn underneath the price when the price is moving up, and on top of the price when the price is moving down. But different people use it differently. Some traders do draw it beneath the price when the price is moving down. That's also fine, but not really the standard way of drawing a trend line. Okay. So as you can see that as you draw this trend line here, the price as it moves down, it still tends to bounce off the level here, the trend line. All right. It's best to draw it on the top because then you can just enter the downwards movement. You can go short when the price goes up to the trend line and starts another impulse wave along with the same direction. Okay. And then we're talking about the round numbers. Again, as I mentioned, for example, Euro USD, if it was 1.1000, that would be a really round number, and that's where you could find a really heavy, strong support and resistance level. Ulrich seems to be having a black screen, although the module shows everybody's seeing it. One moment, let me just pause it for a sec and make it visible again. Ulrich, can you confirm if you now see the screen properly? Okay, great, thanks. So let's continue. The same round numbers, psychological support resistance levels apply to all different types of assets, no matter if we're talking about commodities, stocks, just currency pairs. It applies everywhere, okay? Because people are analyzing the charts. These round numbers, they appear really strong. I mean, people notice these round numbers really well, okay? And also any computerized trading robots also recognize these numbers and then based on these numbers apply their trading decisions, right? So people really tend to see and use these round numbers as good entry and exit points of their trades. Okay, how to apply the SR levels to your trading. The very easiest and most plain way to apply these would be to first identify the nearest 3 support levels and the nearest 3 resistance levels. S1, S2, S3 are the support levels, and R1, R2, and R3 are the nearest support levels, with the R3 being the furthest and the R1 being the nearest resistance levels. And same applies for the support. Okay, you can find these levels daily when you browse the web. A lot of information, a lot of indicators of these daily support resistance levels are provided to you. Now, if you want to apply this to your trading, essentially the easiest way would be to go long when the price hits the nearest support level, and set your take profit to the nearest resistance level, and set your stop loss to the next support level when you go long, right? So it's a really blunt way to trade this horizontal support resistance levels. Although I wouldn't really recommend it to simply trade based on this simple idea, because most likely it will not work for an extensive amount of time. Might work a few times, but long term it won't really provide you any profit. Okay, you definitely have to analyze what is going on the market. Definitely need to understand whether there are any news upcoming. I would highly recommend to stop trading perhaps half an hour or 15 minutes before the news hits, and 15 minutes or half an hour or maybe even an hour after the major news hits, just to let the market calm down a bit and then look for additional trading opportunities. When you are starting to trade, it's really wise to stay out of the market when the news hit, because the news can make the market really, really choppy, and you can really easily trigger your stop losses. Okay. If you trade this simple method, you can also apply pending orders. So you can essentially set the pending orders. If you go long, you can set three different pending orders on the nearest three support levels. And essentially, if you set the pending orders, you can, like it's written in the slide as well, fire and forget. And don't forget to assign the proper stop loss and take profit levels as well. Otherwise, you just initiate the trade, which essentially can last forever, right? So this is something to keep in mind. Okay, I'm not going to go into managing risk yet, because I want to show on the live chart in MetaTrader 4 how to draw support or resistance levels manually. 1 second, let me just open it up. Okay, I see some of you asking questions in the question section. Don't worry, I will attend this question at the very end of the webinar during the Q&A. Okay, so everybody should be seeing Euro USD 1 hour chart here. As you know, Euro USD 1 hour chart is the chart that I like to bring examples with. It's the easiest to analyze and can provide the best examples usually. Okay, so first of all, let's take the horizontal manually drawn support and resistance levels. Now, before I start with it, please note that if you haven't done this before, it might seem that it's difficult. Actually, it's extremely simple, and it just requires a bit of an analyzing eye to be able to define these levels of indecision, and see how far these levels essentially can go, how far you should analyze the price charts to adequately draw the support and resistance lines. Okay, but just to keep it simple, let's take, as you can see, this point is the current hour. This is the live chart. Let's zoom out just a little bit. Okay, so we're going to go a bit into the past and see if we drew some support or resistance lines based on the price movements in the beginning of February, how they would have worked out now. Okay, makes sense? So let's take 7th of February up till 12th of February. As you can see that we can find here some really clear support and resistance levels. Okay, you can see that this is the point when the price is quickly bounced down again, right? So as soon as the price goes up to this level here, it goes back down. It bounces. The resistance level here really heavily rejects the price. Okay, so this is a really good resistance level for the price at this point. Another one we can draw is down here. One thing to note, the price can pierce the support resistance level a bit, but you can never find a support resistance level that with a millimeter accuracy bounces off it straight away. Okay, it always goes up a bit and then comes down. It always pierces it a bit. Okay, sometimes it's really difficult to understand whether the price pierces it and continues the same way, or is just a temporarily small pierce of the support resistance level. As you can see here, it goes up, let's see how much, about 10 pips, and then comes back down again. Okay, it does the same here, but it remains above the resistance level, at which point this resistance level becomes the new support for the price, and then the price goes up. Okay, so it's sometimes a bit difficult to determine or to pinpoint the exact support resistance level, because it's actually a small zone, so to say. So you can just set it visually somewhere in the middle where it makes the most sense. This is how I like to define it, just where the level makes the most sense visually. Okay, so for me, the lower support line makes the most sense and is somewhere in the middle, just considering this point here, considering this bounce, and you can see really heavy indecision here as well. Okay, so let's just take these two support resistance lines first, and let's see how they served in the end of February. Okay. Okay, so you can see that this top support resistance level actually played a relatively strong role in rejecting the price in the 23rd up till 26th of February. So you can see a heavy indecision actually here on the 22nd of February. After the really strong downtrend here, the price, when it reached this level, you see some exhaustion just below it and some consolidation of the price. Okay, and in 23rd of February, the price actually rejected the level that rejected the price really significantly several times in a row. Okay, so it played a really important role on this day. However, the lower line, you can see a really heavy drop here, and when it reached this level, you could still, it pierced it, but it came to retrace that level. Okay, so it did play a role, but not so significant, but because the price still trended downwards. All right. Okay, let's take a few more levels. Let's see how this played out. Let's go a bit further into the past. We have a really strong support level here, as you can see, already at the end of January up till the first start of February. This support level really strong. Okay, very many times the price was supported by this level. Same as the price went down significantly, the price served as a resistance level for the price at this point here. Again, I mean, this level is really precise. Okay, as you can see, so many bounces off. Okay, another level we can find. Let's see. visually this level. It serves as a relatively good support level. So let's take these top lines now, and let's see how these played a role in later February. Okay, again, you can see how this top support resistance level played a role in the middle of February here, directly bounced off after a small rally. Then we see how it supported the price after the drop here. Again, a lot of indecision before it actually continued the downwards trend. The lower line here that we just draw, again, after the rally upwards, you see a heavy indecision around this level again. You see how well this level served as a resistance for the price when it started ranging at the second half of February. Okay, so if you did your chart analysis at the end of January, start of February, you could have really easily used these four support resistance lines to pinpoint your trade entries and exits. After determining that the price is in a ranging mode here, as soon as the price hit this level, you could have gone short and easily earned. Let me see. We are dealing with a 70 pip gain. Okay, so this trade would have been a 70 pip gain, right? So easy as that. You could have set your take profit at the support line that you drew in the first half of February. You could have set your stop loss at this top resistance level. So this is how you manually draw the support resistance line by visually analyzing the charts. It's actually really simple. If you go further into the past, you can see another support resistance level at this point. Heavy indecision here. The price is really bouncing off here again, etc. So really straightforward. Just have to have a bit of an eye. It's really easy to train your eye to be able to identify the support resistance levels. So yeah, just a bit of practice and you're good. So let's now draw a few trend lines on this chart. Okay, now very important thing to mention about trend lines is, and one of the biggest mistakes that traders do when drawing trend lines is trying to they're trying to how to say they're trying to be really accurate with highlighting or pinpointing the lower highs or higher lows when the price is moving up or down. Okay, what I mean by this is you can never have such a draw a trend line with such a pinpoint and accuracy. Okay, if we take the second half of February, this really high peak here, that makes it a bit difficult to draw a trend line because the trend line is really steep. If we took the next lower high, then it doesn't lead us anywhere, right? If we took the next lower high, then it still doesn't lead us anywhere. So it's going to be really steep. We have to take a look at the larger picture. If we drew the trend line here at this point, then the price is yet to get to that level. So in this scenario, let's go a bit further into the past. Let's see how we can draw a trend line here. Okay, we're going to take the very low point of the move, and as you can see, if we wanted to really pinpoint this higher low to draw the trend line, then this point actually doesn't really isn't really reaching our trend line. Okay, if we used the second higher low to draw the trend line, you can see that this move here heavily pierces our trend line, but still is repelled eventually, right? So you can never really pinpoint the higher lows or lower highs to draw the trend line. Something is always mismatching a bit. But still, I would use the same logic, draw the trend line where it most makes sense visually. Okay, so for in this occasion, I'm completely ignoring the wick at the bottom. I'm drawing it from the close of the candle, the bearish candle here, and I'm using the close of this bearish candle. So this would be my trend line. So it's actually piercing it a bit on all points, but it's still a valid trend line, right? So you can see on this occasion, the trend line is actually relatively well supporting the low points, I mean the close points of these bearish candles here, okay? Um, on this scenario, on this example, this trend line really didn't support the price moving upwards after we had such a large magnitude movement upwards and then coming down. So let's take a look further into the past. Let's see what we can find here. Okay, after, let's see, it's a bit choppy here, but no problem. Our trend line would look something like this. Okay, so let's say we take a range of 1st of February until 5th of February, right? So we'll take these three. Let's take these three lower highs. As you can see, they are moving up a bit. They are actually piercing these levels, but that's fine. We still draw it where it most makes sense visually. Okay, so if we have identified a trend line moving downwards using these points here, then the price is relatively well repelled at this fourth point. 1, 2, 3, actually 5th point. Okay, so this would have been a great short trade. This point would be as well um, relatively decent trade, of course, depending on your take profit and stop loss levels. You might have lost it. If you set your take profit too far away, then it would have hit your stop loss. Okay, but this trade would have been a really great one. Okay, so this is, we are using or drawing the trend line at the top of the candlesticks when the price is trending down, and below the candlesticks when the price is moving up. Again, let's draw another trend line here. Let's see how this works out. Using this point. Okay, after the third touch, we have a bit of it is supporting the price a bit, but again, uh, not the best trade, not the best example. As with all technical indicators, all technical approaches you take to trading, they don't always work. Okay, you can raise your winning percentage by adequately using these technical tools to assist you, but they never deliver 100% accuracy. Okay, so these are the trend lines. We draw some horizontal lines as well. You can insert Bollinger Bands for a dynamic support resistance levels. And let me just see what parameters. 20 to apply to close, that's fine. So A Bollinger Band is a really good indicator because it tends to contain the price within its bands, okay, between the channels. As it reaches the top band, the price bounces off. As it reaches the lower band, the price bounces back into the Bollinger channels. Okay, a Bollinger Band is an indicator that deserves a completely separate webinar on its own, because this is one of the most useful technical indicators we use here in Blue Sky Forex. But this is one of the dynamic uh, technical indicators which you can use for support and then resistance levels. The middle line here is a moving average, which separately can also be used as support to identify support resistance levels. You can use multiple moving averages and their crossovers to find your trade entries and trade along with the trend or the next impulse wave, etc. Okay, so when the price is heavily moving downwards, for example, then the moving average serves as a resistance line for the price in a similar way as the trend line, but it's drawing itself dynamically onto the chart. So as the price is trending downwards, when it reaches the moving averages, it bounces back down and continues its trend. Okay, so really straightforward, really easy to use. The moving averages can definitely be used in so many different ways. Moving averages can also be used on top of different indicators to show the moving average of a certain indicator value instead, not the actual price movement. So let's see, we have now covered. Actually, I want to show you manual numbers. I'm sorry, round numbers as well. That is something I haven't showed you yet. Let's pick a round number. Let's take 1.3000. Let's draw it here. Try to be as accurate as possible. Okay, let's zoom in a bit. Maybe we can. Okay, let it be 4 pipettes off 1.3. Okay, so let's now scroll back into the past. I mean, this the Euro USD was at this price quite a long time ago, so there is some scrolling back to do. No worries, just bear with me for a moment. Okay, a bit too far. Just a sec. A long time ago. Okay, starting to get there. Okay, so we are really close. Okay, what a crazy move here. We're gonna just skip that. Okay, I think we can ignore that one. I'm not going to get a good example out of it here. Let's take a bit more recent and more logical level in this case. Let's jump down to 1.0 let's take a smaller round number, 1.21000. Let's see where that leads us. Okay, well, it's, yeah, pierced right past it. No worries. No, we need to take a more logical level. When it was more closer to 1.1. Oh, sorry for that. I'll draw another one here at 1.1 exactly. Okay. At all these levels, the price is right shooting past it like it was nothing. Okay, well, I'm not gonna find any good points here except for this one. I mean, there's a large gap right at this 1.1 round number. Okay, we can also use another pair perhaps. Okay, well, anyways, you get the idea. I'm not gonna get a good example for a round number here on this occasion, most likely. Again, quite severe action at this point. Okay, repelled only once before the extreme rise upwards in November 2016. Okay, anyways, now let's get back to the slides. Let's talk about managing risk. Okay, so risk or reward and risk ratio. Now, it's definitely important to define your risk reward or reward risk ratio on this example. And depending on whether you're scalping, whether you're trading longer term position trading, whether you're day trading, when you're scalping, you should aim for risk or reward risk ratio of 1:1. And then this is even when you are starting out with longer term trading like position trading. Reward risk ratio of 1:1, that means that you are setting your take profit the same distance away from your entry price as your stop loss. Meaning if your stop loss is 30 pips, then your take profit is also 30 pips. Throughout time, when you get more experience, you should try to aim for a better reward risk ratio, 2:1, which means your take profit is twice the size of your stop loss. This also means that each and every trade can yield potentially twice the profits, right? So you're risking less to earn more. So this is really important to keep in mind that it's always better to risk less with potentially earning higher returns. So always try to aim for a better reward risk ratio. However, when you set that reward risk ratio to too high, then you might never hit your take profit levels. And before the price actually reaches your take profit, it might already reverse and hit your stop loss instead. So it's not wise to be too ambitious with your take profit levels. So try to uh, keep it sane. So think about it, see how it works out for you at first. Whether you're scalping, then of course reward risk ratio is definitely smaller. If you're position trading, then you can certainly aim it to be higher. Okay. Dollar cost averaging is a very interesting topic. It's a bit similar like martingale, but please note to try to avoid martingale as much as you can. This martingale is dangerous. You can empty your account in a matter of one trading session, no matter how much profit you have earned, because the market can remain trending in one direction for longer than you can remain solid with your account balance. Now, dollar cost averaging is a different approach to martingaling, and I'll explain what this is. Now, let's say your standard trade size per trade is always one lot. Okay, so you always trade one lots. Now, instead of initiating one trade with a standard lot size of 1, instead of that, first initiate one trade with a lot size of 0.3. Okay, in your chosen or desired direction. Now, if the trade or if the price moves against you, then you initiate another trade, again with a lot size of 0.3, but that second trade is already with a better price, still in the same direction, on the same asset. Okay? If the price again moves against your desired direction, you initiate the third trade with a 0.4 lot size, also the same direction and the same asset. Now in total, you're still trading a lot size of 1, but you initiate 3 trades instead of 1, and you are getting a better price with every consecutive trade. Okay, so ultimately, this can increase your returns and lower your losses. But please note that if you're using this method and if your initial trade accuracy is really high, 70% and more, then dollar cost averaging can actually lower your returns ultimately. If your accuracy is around 50 up to perhaps 60%, then this dollar cost averaging method can definitely increase your ultimate longer term gains from trading. Okay. You can also use trailing stops. Trailing stops can be tricky to use because if you're scalping, then there is no reason really to use them, because for when you're scalping, you're aiming for these low pippage gains around 15, 20, 25 pips, and trailing stops should be started to use and set from your entry price only for like 15 pips further away. So 15 pip trailing stop is minimum, I would say. Then you will not hit your stop loss or trailing stop so quickly with just these small price fluctuations. Okay, if you're position trading and aiming for these larger gains, then using a trailing stop can really help you out with locking in some gains. All right. So when scalping, don't use trailing stops. When you are a longer term trader, then definitely you should be practicing using the trailing stop. Now, a few dangers when you come across when trading. Don't trust bots. 99% of them are scams. They are driven by affiliate marketers who know nothing of trading. They have just composed or taken few technical indicators, mix match them together into one expert advisor in MetaTrader 4 and just studying them and or giving them away for free, so you would use them and empty your account. Okay, most of these expert advisors are designed like that. So if you want to use or test out one of them, definitely do it on a demo account. If that works for an extensive amount of time, 3, 4, 5 months, then do sufficient background checks, and then only apply to a live account, and really with a really small lot size, just to test it out. Be really careful. Okay, it's sad but true, but only 5% of traders make money in FX in longer term. That's true. It's mostly based on the psychology of traders. Most of people just cannot handle trading ultimately. When they win, they get too excited and then make small, stupid mistakes and empty their accounts. Same thing when a trader loses, they get frustrated. They again start making stupid mistakes and then cause more damage to their balance. So this is the truth, right? So only small percent of traders actually make money longer term with trading. Our aim is to increase that percentage and then actually help you survive on this harsh industry. Now, blowing an account is not a bad thing. It's part of the journey to eventual success. Most of us have blown an account or two. It's completely okay. That if you blow an account, it means you need to change something. You need to change your attitude towards trading. You need to change the session that you're trading in, change the strategy, essentially change what you're doing when you're trading. Okay, it might mean change only a few things. It might mean change everything. Now that's already dependent on what you're actually doing. Nobody actually can tell you what you need to change. You need to practice it out for yourself. You can use demo accounts. A lot of people say that when using a demo account, you won't really get that real money trading feel. It is true, because you are most likely going to trade a real money account completely differently than you're trading a demo account. Because when you are trading a demo account, you're not losing anything, right? You can test out the strategy, that's fine, but you don't get that anxious feel if you are out of the money for some period during the trade, and it's a completely different thing. But a demo account, but testing out a strategy on a demo account is totally fine, but you need to really revise that same trading strategy when you're trading it on a live account, and don't let your emotions come in play. That is the most dangerous thing. Now, about signal services and signal rooms, a very small percentage of them are legitimate. Again, if you want to use any signal rooms or signal services, before using their signals to trade a live account, use them on a demo account. The same thing as with trading bots and robots. Before going to trade them on live accounts, ask for a performance record and audit trail. Okay, that is really important. Keep that in mind. Don't jump in with a live account straight away. Most likely, you're going to empty it. All right. Okay, so it's time for questions. I already have a couple of questions here. I will quickly do my best to answer them. If you have any other questions upcoming, don't hesitate to write them in the questions section. Okay, a second. Albert is asking, if I trade 1 day time frame in MetaTrader 4, should I be worried about all the high impact news? Yes, you should, because you can never predict what the high impact news is going to do with the price. It can move the price 100 pips even really fast. Okay, so it's always better to be cautious. Throughout time, when you are analyzing the news and what news are impacting what currency pairs and what assets and how much, after gaining this knowledge, you can certainly start practicing trading with the news and actually benefit from these movements. But when you are just testing things out, when you are a beginner, then it's highly recommended to stay out. Okay, but it's worthwhile just so to say paper trade or demo trade the news just to get a hang of it, because trading the news can be extremely profitable, but only if you do it right. If you do it with hesitation, if you do it wrong, then you can empty your account really quickly with the news, with these large movements, essentially, even, I mean, especially if you are not properly setting your stop loss before you enter the trade. Okay. One thing I forgot to mention, that when you are trading and when you're placing trades, always define your take profit and stop loss levels in the beginning of the trade and stop meddling them after you have entered the trade. Okay. If you start lifting your stop loss further away from the trade when you are in loss, you will simply increase your losses. It is possible that the price will turn around and go into profit, but longer term and ultimately, by doing this, you will definitely increase your losses. Okay. Okay, Carlos is asking, do you draw the lines with the body of the candles or concludes the wicks as well? Now, as I mentioned before, when I draw the trend lines, I don't pinpoint to the wicks always. I draw the trend lines and the support resistance lines visually where it visually makes most sense. Okay. If you try to, with extreme accuracy, always pinpoint to the very tip of the wicks, then at some point the trend line, in the future price movements, can be really inaccurate. Okay. So sometimes you should pinpoint the wicks. Sometimes you can use the actual edges of the candle bodies as well, or even middle of wicks is also fine, depending on the actual price movements. This already comes with experience. You need to practice it a bit and have an eye for it. Okay, Albert is asking, is it fine to trade SR levels, the floor SR levels on a daily time frame, using the breakout of the weekly time frame SR levels? Yes, it is. Now the thing is that when you're trading SR levels, you can definitely define the support resistance levels on the larger time frame and then zoom into the smaller time frame to trade these. Why not? But I personally would use the SR levels on the same time frame to actually initiate trades on the same time frame. In some cases, if you're unsure whether the SR level would play a decent and a strong role, then you can zoom out to a larger time frame to see if on a larger time frame it makes sense. But if you're trading on the daily time frame, then I would first draw the SR levels on the daily time frame and then see if they make sense on the larger time frame. Not vice versa. This is what I would do. Mangami is asking, can we get the slides? Sorry, the presentation files will not be shared or sent out. You can watch the recording of the webinar on Hot Forex website on the past webinar section when you're logged in. Vinutha is asking, what is the best time frame for day trading? That completely depends on where do you live, and each and every trading session, the European session, the US session, and the Asian session, they have different characteristics which you should get used to and stick to that certain session. I would highly recommend trading on those 3 different sessions and getting a feel to it and seeing what session really suits you best, and then stick to that session just to get used to the characteristics of these different sessions and then continue. Okay, Ulrich is asking, what do you think of indicators that draw support resistance lines? Are they useful? Yes, they are, because they do a lot of work for you. There is one support resistance indicator that I found on the web that I have used for years, and this is called, I think it was TCH 2.0. It's a really difficult name that it had, but if you Google, um, I think it was ridiculously good support resistance indicator, something like that, and it should pop up. 1 second, let me see if I can quickly bring it up for you. Uh, okay, surprisingly good support and resistance indicator. Okay, and the part of the support resistance indicator name is TLBOC V02. Okay. Okay, Albert is asking, when managing risk, is it fine to use correlation to filter out pairs with high positive and negative correlations, especially when trading with SR levels? Definitely. You should never trade correlated pairs simultaneously. Okay. However, I would not really recommend analyzing support resistance levels on one correlated pair and applying the information that you gained onto a different pair and trade a different pair. That is something I wouldn't recommend, because the support resistance levels can become inaccurate. Carlos is asking, with the Bollinger Bonds indicator, is it fishing tip strategy? The candle have to be fully closed at the outside and the inside band, or can it be partially? I am not familiar with the fishing trip strategy directly, but if you're planning to use Bollinger Bands and simply trade them when the price reaches the top band or the lower band, it's a bit too simplistic approach. It doesn't usually work longer term. So you have to analyze the market conditions first. There are certain Bollinger Band formations that you can analyze every day on the market that you can utilize to benefit from, but simply trading at the top or lower Bollinger Band out of the bat, that doesn't really work. Okay, Dabo is asking, how many trades will you advise to take daily? This already depends whether you are a scalp trader, whether you are a scalper, or you are a day trader, or you are a position trader, etc. Now, if you're a scalper, then most likely you're aiming for the small pippage gains, like 15, 20, 25 pip gains. And in this case, you can um, trade maybe 10 trades per day, maybe 15 maximum. If you are a position trader, then most likely you're initiating maybe 2-3 trades per week, but these trades are properly, technically, and fundamentally analyzed. Okay, because you're aiming for these large gains. In this case, you don't want to initiate like 50 trades per week. You're aiming for these highly accurate, high gain trades, and you are trading, 1, 2, 3, maybe 5 trades per week tops. Any scalping strategy you recommend? Carlos is asking. Not really. I mean, There are thousands of different ways how people scalp, and based on my experience, based on my research, all of them work sometimes and don't work some other times. I mean, these old scalping uh, method is really sensitive to intraday trading conditions and also news. So with scalping, you can really not apply the same strategy, over and over again and expect extensive longer-term profits. When you're scalping, you should reevaluate what you do uh, each and every day, actually. So it's really difficult to say which is a good strategy to scalp with. You can pick a few of them and test them out for yourself, and I'm quite sure you will come to the same conclusion that one day it works, the other day it's a complete disaster. Okay, I would scalp completely based on price action, what the price actually is doing, just incorporating support resistance levels, maybe implementing Bollinger Bands, and then scalp, maybe five trades per day. But applying any other technical indicators to scalp and just following that same strategy all over again very strictly, that doesn't really work. Okay, ladies and gentlemen, we are already really past the hour mark. That was perhaps for my over explaining. Sometimes I do tend to do that, sorry for that. But thank you very much for your questions. Actually, Magnus, yes, that is the exact same indicator that I said before. Yes, support and resistance, TLBOC V02, version 02. That is a good support resistance indicator, and it draws the support and resistance lines onto the chart, onto the same chart on the same time frame, even from higher and lower time frames. So it's a compact one. You don't have to switch time frames either. Okay. Any questions that I didn't answer today on this webinar, please send the questions to webinars@hotforex.com. And I do appreciate you attending this webinar today. Thanks for that, and we'll see you next week. Take care, everyone.